Hi, my name is Alexander Elliott. I'm a certified financial and tax advisor. I do both. Welcome back. In segment one, we discovered your tax personality and how your mindset influences your decisions. Now, let's dive into tax smart planning. Okay? The strategies that help you keep more of your money in your pocket, and hopefully you reinvest that and buy, other stuff, properties, investments. We have three buckets. Okay, there's three buckets. Imagine three buckets in front of you. You have one that's taxable, you have one that's tax deferred, and you have one that's tax free. Okay, we're going to talk about all three. The taxable would be a brokerage account or rental income. Tax deferred would be traditional IRA or 401k or pensions. Tax-free would be a Roth IRA, a Roth 401k, municipal bonds. Each bucket has its own withdrawal rules and tax rates, okay? The order you withdraw from these determines how much taxes you will pay each year, or not pay, obviously. The flow of money between buckets. Here's the core principle, okay? Start by using your taxable bucket up to a strategic threshold. Often it's the top 12% bracket, all right? Next, layer in the withdrawals from your tax-deferred bucket in control amounts. Finally, tap into your tax-free bucket when you need extra funds. This sequence smooths your tax bill and avoid tax creep, or creeps up, okay? All right, Roth conversions and timing. This is very important. A lot of people ask about this. Now, let's talk about the Roth conversion. Moving money from a traditional IRA or 401k into a Roth will trigger taxes now. But all future growth and withdrawals are tax-free. The best time to convert is during years of your lower income. It could be before you retire or right after you retire, and before the required minimum distribution, which begins at age 73. Okay? The RMD and strategic planning. Okay. All right. Speaking of RMDs, once you're 73, the IRS mandates withdrawals from your tax-deferred accounts. Failing to plan can spike your tax bill and even increase your Medicare premiums. Okay? By modeling the RMDs early, sometimes as early at age 60, we can spread out conversions, charitable distributions, and withdrawals to minimize tax surprises, or a letter from the IRS too. You guys don't want to get that. All right? Here's a case study. Jane has a 3-year plan. We came up with a 3-year plan. Let's illustrate with Jane, age 68. She has about $200,000 in taxable investments, $300,000 in her 401k, and $50,000 in her Roth. Okay. Year one, we want to withdraw $24,000 from the taxable to stay in the 12% bracket. Year two, we want to take out $20,000 from her 401k and convert $10,000 to a Roth. Year three, we want to convert another $25,000 to the Roth. So future growth is tax-free. By sequencing wisely and timing the conversions, Jane has reduced her lifetime taxes by tens of thousands of dollars without stress or surprise or a letter from the IRS. Okay. You don't want one of those. All right. But in segment 3, we're going to explore how Behavioral nudges ensure these smart strategies actually gets implemented. Anyway,